Happy Tuesday, Forefront family. Like I always do, we'll start with some positivity. 283,178 people have recovered from COVID-19, according to the COVID Tracking Project. We did 346,094 tests in the United States yesterday, just slightly under the 7-day average for tests, but still a healthy ramp up, and it's a welcome sight as we continue to march towards our end goal, which is a solution for the virus spread and eventually a vaccine to eliminate the virus altogether. Something I commonly say to everybody, and I wish I was the one who made it up, but we've all heard it before. Diversification means you always have to say you're sorry. If everything of yours went up or down at the same time, you wouldn't be diversified. And the current market recovery is the perfect example of this mantra. So some quick statistics. I hope we don't get too far into the weeds. The S&P right now is down less than 10% for the year. It's crazy to me, but down less than 10%. 49% of the index are down more than 2 times what the broader S&P 500 are down. And 51% are down somewhere between 0 and 30%. There's a sliver, about a quarter of the S&P, 27%, that are down more than 30% overall for the year still. And that finally leaves us with that small sliver of FANG stocks and tech stocks and stay-at-home stocks that have done well and are up year to date. But such a wide disparity shows that to eliminate the risk that diversification helps to eliminate means that everything can't go up in lockstep. This is really hard to see though, because over the past 12 years, every correction that we've had has had a correlation of basically 1. Everything drops hard and fast. But if you push through that initial week of panic, the cream rises back to the top. Yesterday, we saw the Dow rise nearly 1,000 points. Now, it was largely based on the data coming from Moderna on their phase 1 trial of a COVID-19 vaccine. This is great news. We need a vaccine, but the exuberance seems to be a bit overdone. Expedia yesterday, and we all know who Expedia is, was up nearly 20%. As if they created the vaccine and are not just a travel booking site, I guess. But with the markets having recovered, a pretty good amount since the initial crash, now is the time to start to reevaluate your equity mix. Although we continue to make changes to the portfolios to take advantage of opportunities, Many of you felt concern and agita for your portfolios that you haven't felt in a number of years. And for some of you, you haven't felt that concern since you retired. Now is the time to adjust your risk tolerance. That does not mean we need to go one way or the other, all to bonds, all to equities. We're in the midst of a global pandemic still. And although the data continues to improve, the problem doesn't go away because the barbershop in town or Starbucks opens up. Volatility is here, and it's going to be here for a while. Take advantage of run-ups in the market to reposition risk so that it's positioned well for your life. I have set up a number of ways for all of you to take advantage of the technology needed to set up quarterly reviews. Of course, you can always call or email me directly. But if you go to forefrontwealthplanning.com, on the top right-hand corner, you can click on Schedule Your Appointment. This will bring you to my calendar. You can pick an available time that works for you. You'll automatically be sent information so that I can share my computer screen with you during our review. This way we can go over the current portfolio, any changes we've made, and the options that are there to meet your goals going forward. You can also find that link to set up an appointment in my email signature, as well as the information below this video on YouTube. Take advantage of this chance to make sure that the risks we're taking are in line with the risk you want to be taking and the risk that you need to be taking to meet your goals. Have a wonderful Tuesday, everybody, and I look forward to talking to you all very soon.